continues to be a truly interesting time for real estate markets. If you wind the clock back a year, some market commentators with otherwise strong credentials had predicted that by now we would have seen falls of 20% or even as high as 30% nationally with the rate setting we have at play. These seemed fanciful at the time and were cause for some alarm, but they have clearly not come to pass. So, where are we at here in July 2023? Market data shows the national property market continuing to defy gravity. After falling around 10% nationally after the post-COVID surge, and remembering that nobody rings the bell at the top or bottom of a cycle, 2023 has been a year where prices stabilized and ultimately got back off the canvas for another round. Nationally, since February 2023, property prices have been increasing incrementally. Since February, national prices are up by 3.4%. Forecasts and models were updated, theses recalibrated, and now broadly, this rise in property prices is anticipated to continue through 2023 and into 2024. Our view throughout was that property could fall by around 15% plus or minus from peak to trough in some locations. So as we look forward, where are we at, and is the current increase sustainable? The driver of the recent upwards movement is simple. We have full employment coupled with a surging population growth. And on the flip side, total stock on market is super low, well down from 2022 and well below the 5-year average. We have people ready and able to buy a house, but there isn't enough stock to go around. The resulting rental property shortage is a flow-on effect from this. However, if you think we are big property bulls, you'd be mistaken. Measured caution is the approach from here. We don't predict any large falls across national prices unless you see a glut of new listings in the short term. What is more likely is for prices to move sideways rather than a sustained environment of price increases. Beneath the current figures, there is still some underlying softness that the demand or supply dynamic is covering. Remembering that the very point of a sharp increase in interest rates is to slow down types of inflation in the economy. It will be no surprise that after the past 14 months, some areas of the economy will be feeling the pinch. And in recent months, have seen a jump in the level of houses being sold in capital cities at a loss, off a low base, and even in an environment of prices moving upwards. Some people just need to exit the market and are unable to hold to a point in time where the market is more in their favor. So, we might be starting to see the early flickers of a pickup in additional housing stock onto the market. That being said, bank loan arrears are still low across the market, and to the extent they remain so, this data, hidden below the headlines as it is, will probably go unremembered. There have certainly been higher levels of loss-making sales at different points in time, and the demand-supply dynamic still sits in favor of the seller for now. It's just a salient reminder that positive upwards movements in prices is never guaranteed, underlying the importance of partnering with cautious managers who build portfolios with markets up and markets down in mind.